So let's move on. So that's how we record. That's how you record the issue. That's how you record the issue of shares. So the par value is what we record, the share capital. Then the share premium is based on how much was the premium. Then let's again record. So you could state here on the share capital that is ordinary shares. Then let's have the preference shares. So for the preference shares, the bank, we are recording how much we received in total. So it was 60,000 shares times the market value is $50. Each share in the market is going for $50. So this would be 60,000 times $50. Then we move to, from the bank, we have the share capital. So for the share capital, or let's specify that this is preference share. Preference shares, then share premium. So the preference shares here, always for the share capital or for the shares, you take the par value, that's 60,000 times. The par value of each share, the shares were said to be shares of 80 cents each. So you'd multiply that with 80 cents. So that would be 60,000 times 80 cents. Then we come here. So for the share premium, it's 60,000 times. The share premium, we're told how much was the share premium? It's 70 cents, yes. So that would be times 0.7. So that would be 60,000 times 0.7. So we're done. So in the bank, we are putting all that we received. In the bank, we are putting all that we received. Then the share capital is the par value. The share premium, multiply the shares by the premium per share. Then when the shares are being issued, we have an issue at full market price as above. The above issue is said to be an issue at full market price. The above issue is said to be an issue at full market price. We can also have an issue of shares at a price below the market price, or sometimes for free. So when shares are sold to shareholders at a price below, let's say it's the ordinary shares. The ordinary shares, we know they're going for $2.40. If they are sold at a price below existing market price, we can have what we call the rights issue. So what is a rights issue? So the rights issue. So if we are looking at the rights issue, this is when an issue is made to existing shareholders. The rights issue, it has to be existing shareholders. If it's the rights issue, this issue has to be made to existing shareholders. So this is when an issue is made to existing shareholders, at a price below the market price. When an issue is made to existing shareholders at a price below the market price. So take note of two things here: existing shareholders and below the market price. So the shares are issued to those who already have shares. We are selling to those who already have shares, but we are discounting these shares for them. So they are paying, but they pay less than what someone would have bought these shares for if they did not have the shares. These shares are issued in proportion to existing share. They are issued in proportion to existing shareholders or to existing shares. So meaning if you have more shares now, you get more. If you have less, you also get less. So you're given more shares based on those that you currently have. So let's have an example to demonstrate this. KD Limited currently has 50,000 ordinary shares. Currently has 50,000 ordinary shares. The company decided to make a bonus issue. So not a bonus issue, a rights issue. Of 2 for every 5 shares held. Decided to make a rights issue of 2 for every 5 shares held. Decided to make a rights issue of 2 for every 5 shares held at $2.20. At $2.20. So $2.20 in the outside there is $2.40, but we are selling these shares at $2.20. So we want to record this. It's almost the same. There are just very few adjustments. So let me rather copy this, then I'll make the adjustments on this one. So the first thing though is to understand how many shares did we issue as bonuses. It's not 50,000. The question said we have 50,000 ordinary shares and we decided to issue, to make a rights issue. So how many shares did we issue? That's the first question. So the number of shares issued. How do we calculate this? They give you the ratio. They said 2 for every 5. That's 2 over 5. 2 over 5 of what? Of the shares that are there. So if the rights issue is 2 for every 5, you say 2 over 5 of the existing shares, which is 2 over 5 of 50,000, giving us 20,000. So 20,000 are the number of shares for the rights issue. Now the calculation is the same for the rest of what you're going to do. So you're now going to say 20,000 times the price we sold at. It's not 240, it's 220. So we are going to say that the 20,000 times the 220. Then the par value is not affected. The par value is not affected by, remember the par value was dollar, it still remains dollar. What is affected is the premium. So if there is a bonus issue, the par value still remains the same. But now the share premium, it used to be $1.40. It means now we are saying $2.20 minus the par value. So we're now saying 220 was the market value now for the bonus issue. We are selling at 220. So it means the premium now we are saying 220 minus the par value of dollar, giving us, instead of $1.40, we are getting a premium of $1.20. So the rights issue is going to affect our premium. So meaning here, the share premium is going to be, that's 20,000 times $1.20. So we have the 20,000 times the $1.20. A moment. So the 20,000 times the $1.20. Now let's move. So that's how we would record the entries, provided there is a rights issue. So take note, the rights issue, you need to first of all figure out how many shares, because the question did not say 50,000 are the shares that we issued. So they give us the shares that are there, then they tell us the proportion of the rights issue. 2 for every 5, you'd say that's 2 over 5. Now, let's proceed. The next type of the issue we are going to talk about is the scrip or bonus issue. So we have the bonus or scrip issue. Bonus or scrip issue. So for the bonus or scrip issue, or the market capitalization issue, the bonus issue, this is when shares are issued for free to existing shareholders. So for a bonus issue, those that have shares, they are being given shares for free. They don't need to pay for these shares. So a bonus or scrip issue, this arises when shares are issued. This arises when shares are issued for free to existing shareholders. So take note, these ones are free. That's the first thing to take into account. And number 2 is to existing shareholders. They say in some cases it's not really for free because they are given in place of dividend. So where we give them the bonus issue, we might not issue a dividend that year. So the company can be maybe setting aside money for other projects. Then you can say, okay, this time around, we're going to just, as a way of appreciating you, we'll give you more shares, but we're not going to give you a dividend. We are going to use it for the projects that we are tending to do as the company. So the bonus issue, it means the bottom line, the shareholders are not paying for these shares. So since the shareholders are not paying, the issue does not result in cash movement. The issue does not increase money in the business. but it increases shares. So how do we finance this? Because the double entry, we are saying, if the shares are increasing, what about the other issue? What about the other entry? What is going to finance these shares? Since it's not money that is received in our bank, where are we going to finance these shares? What are we going to finance these shares with? So we say the bonus issue is financed by reserves. The bonus issue is financed. The company has sold the shares, but where is the money going to come from? Because it's not going to get into the bank. It is taken from our own reserves. It is financed by the company's reserves. So the bonus issue is financed by the company's reserves. So in most cases, the reserves are left in their most flexible form. So when financing the bonus issue, we leave the reserves in their most flexible form. Meaning we start by issuing. We start by taking money from reserve. From reserves that are less flexible. So we start by taking money from reserves that are less flexible. So for our reserves will be given in the question. So the reserves of the company, if we are talking about reserves, it's just money set aside as well. So we can have money set aside as retained earnings, or it can be put in a reserve. So maybe before I proceed, let's talk about the reserves. So for the reserves, this is money set aside. This is money set aside for use in the future. We have set aside money in the business so that it can be used in the future. So the reserves are in two. We have reserves which are called capital reserves. And we have reserves which are called revenue reserves. So if it's a capital reserve, it means this money, we have not set it aside because we want, but it's actually the law that requires that you set this money aside. For example, you should have money that you have aside in the event that the company is to liquidate. That money, you use it to pay those whom you owe, your creditors. So the capital reserves, these are set aside as a requirement by the law. A requirement by the law. So you don't choose to have these capital reserves. The law requires you to keep these reserves. You keep this money aside, the capital reserves. Then we have the revenue reserves. These ones are created. So the revenue reserves, these ones these are created out of the company's profits, out of the company's profits, and are not a requirement by the law. They are not a requirement by the law. So if a reserve is a capital reserve, it cannot be used to pay dividend. Let's say the company has no money that year. We can't take money that is in a capital reserve to pay dividends. So capital reserves, which are these capital reserves? So the capital reserves, we can look at reserves such as we have what we call capital redemption reserve. This is a reserve created when we are redeeming the shares. Remember, we said we have redeemable preference shares. When we are redeeming those shares, we are required to create what we call a capital redemption reserve. We have also a revaluation reserve. We also have share premium. We also have share premium. These are capital reserves. Then the bottom line is the capital reserves cannot be used. These cannot be used to pay dividends. These cannot be used to pay dividends. So if we don't have money as cash, or we can't take money from the capital reserves to pay dividends, then we have the revenue reserves. So the revenue reserves of the company, we can have, for the revenue reserves, we can have the asset replacement reserve. So we are keeping aside money so that we can use that money to replace the assets. Asset replacement reserve. We also have the general reserve. We can also have the retained profit. It's also a reserve. So these ones, we can take money from these reserves and pay dividend. So if money is in revenue reserves, it can be used to pay dividend. Revenue reserves can be used to pay dividend. So the revenue reserves, they can be used to pay dividend. So for a bonus issue, when a bonus issue is made, we take money from the reserves. We are not going to debit bank. In fact, we are going to reduce our reserves. A bonus issue reduces reserves. But which reserves? So a bonus issue reduces reserves, and it can be financed by the share premium and the revenue reserves. So the revenue reserves, the share premium, these can finance the bonus issue. So let's have an example to maybe give So KD Limited. KD Limited has sorry. The following, let's say the following was taken, the following extract. The following extract was taken from the books of KD Limited. Books of KD Limited. The following extract was taken from the books of KD Limited. They have the equity and liabilities. So we have the equity and liabilities. So for the equity and liabilities, we're going to have the ordinary shares. So we have ordinary shares, let's say ordinary shares, let's say these are of 50 cents each. Then they give us a value, they can give us a value, let's say 200,000. Share premium. Share premium 15,000. Share premium, then we have general reserve. General reserve 46,000. Retained profit 54,000. Let me reduce this one, sorry. Instead of 200,000, let's put it at 100,000. So then we are told that the company made a bonus issue. The company made a bonus issue of 4 for every 5 shares here. The company made a bonus issue of 4 for every 5 shares held, leaving the reserves in their most flexible form. Leaving the reserves in their most flexible form. So show the journal entries to account for the issue. Show the journal entries to account for the issue. Show the journal entries to account for the issue. So the first thing here, so we have our debit. Before we actually get to the debit and credit, let's know how many shares did we issue. So the first thing is, let's tell how many shares were issued. So we can say the number of shares issued. So the number of shares issued is 4 for every 5. 4 over 5 times. How many shares did the company have? So they're saying each share is of 50 cents. And the shares have a value of 100,000. By the way, this is the value of the shares. So you don't say 4 over 5 of 100,000. 100,000 is not the number of shares, it's the value of the shares. So if each share is 50 cents, how many shares do you need to get 100,000? You divide. So it means it's 200,000, because if you say 200,000 times 50 cents, that's where you get 100,000. So you are saying 4 over 5 of 200,000. 200,000 are the shares that we had. So what is the number of shares for the bonus issue? That's 4 over 5 times 200,000. So the shares for the bonus issue is 160,000. So the shares for the bonus issue is 160,000. So these are the number of shares. But when we are recording the bonus issue, we are going to debit, and we are also going to have the credit balance there. Now pay extra attention for this part. So we said we are not debiting bank because no money is, we are not going to have any money coming into our bank. We have to debit the reserves. But when you are debiting the reserves, we debit the value of the shares. So take note, these shares are not of dollar like the ones we did previously. These ones are of 50 cents. So we need to know the value overall, or we can even do it this way. So we said we debit the reserves. So you debit the reserves. So the reserves, you start from the share premium. If you are leaving the reserves in their most flexible form, you are starting from the reserve on top, going down. So it means we want 160,000 shares. But what is the value of these shares? Because this value is going to be taken from the reserves. So you start with the share premium. If the share premium has enough money, we can just debit the share premium alone. But let's check. The shares that we want to redeem, so not redeem, that we are giving as bonus shares is 160 times each share is for 50 cents. So it means we are supposed to debit 80,000, but we cannot debit more than what is in the share premium. I'm recording this so you can try to, I'll send it so that you try to go through it again in the event that you miss anything. So we are saying that we are supposed to debit the reserves, and these are the reserves. Let me highlight the reserves. So you can't debit 80,000. Debiting a reserve is removing from a reserve. You can't remove 80 from 15. So the maximum you can remove from share premium is 15,000. So in total, you have to remove 80, but the maximum you can take from share premium is what is in the share premium account. So you debit share premium. If there was 95, you could debit 80 and that's it. But in this case, there is less than what you need to finance the issue. Why? Because what you need to finance the bonus issue, you need 80,000. There are 160 shares you have given them, but these shares are worth 80,000. So for the share premium, you take the 15 that is there, you move to the next reserve until it's now 80,000. So general reserve. So in the general reserve, 15, if we add 46, and again, it's not yet 80,000. So you debit the general reserve in full, then retained profit. Can you help me work out how much are we left with to make it 80,000? If we add 46 plus 15 to make it 80, pass it how much? What's 46 plus 15? 61. So the retained profit, you're just going to take the balance to make it 80. So you're just going to take the balance. So you're not going to debit everything in the retained profit. You just debit the remaining amount because the issue is supposed to be financed by a total of 80,000. And this 80,000 has to be taken from the reserves. So you take what is in the share premium. If it's not enough, you go to the next reserve, which is below share premium. After share premium, you go to the next reserve until it's enough to finance the redemption. Then you credit, because this is a bonus issue, it increases ordinary shares. You credit ordinary shares. So for the ordinary shares, how much are we crediting? Remember, we sold 160,000 shares times the par value of each share is 50 cents. So it would be 160 times 50 cents, that's 80,000. So it should be equal to the total of the debit. So take note of this part. Let me just quickly repeat the part. So first of all, determine how many shares are you giving them? It's 160. What is the value of these shares? You multiply by the par value to say each share was for 50 cents. It's given here that each share is for 50 cents. So the value of these shares you're giving them, it's 80,000. But you have to take this 80,000 from the reserves by debiting them. So you can't debit more than what is in the reserve. So for share premium, there's 15, you only debit 50. You get to the general reserve, there is 46. You debit 46, but it's still not yet 80. So you move to the next reserve, you take the balance to make it 80,000. So that is the bonus issue. That's with the bonus or scrip issue. Shares are not being paid for. The shareholders are getting this for free. So it tends to affect our reserve.